Okay, so this is chapter 1 of money and capital markets. So let's start looking at the slides. Okay. So these slides, just so you're well aware, I did not make these slides. These slides are from the publisher. The value that I add to this is that I am talking about it, I suppose. So this is our introduction. This is kind of a dumb slide. I'm not sure. That's not going to talk about it. Okay, so what are we going to talk about in this course? This course, as the title suggests, is about money and capital markets. And so what that represents for us is a few things here, right? Is that first there is money, right? Money that is supplied from a central bank. And it's managed by banks, people, and businesses. By that I mean the central bank is controlling the money supply. That's what central banks do. They control the money supply, and that money supply then grows or shrinks based on the actions of businesses and people and the lending practices of banks. So that money supply kind of changes based on the level of economic activity and the lack of or in promotion of economic optimism. Now that money is then transformed in the capital markets. And what the capital markets represent is they represent investments in the means of production. That would be in things like bonds, equities, to name but a few. And so really you can think of this course as treating these two specific markets and only focused on these two specific markets. An essential feature to understanding finance, but also an essential feature to understanding economics. So let's go back to somewhat of a review, back to your days of when you took principles of macroeconomics, perhaps even with me when you took principles of macroeconomics. Money is basically anything that others accept. So usually when we're talking about money, we're talking about a fiat money, meaning it's just printed on paper. It's worth the thing it's printed on. It's not backed by gold, not backed by silver. So money in general serves four purposes. It's a medium of exchange, a store of value, a unit of account, and a standard of deferred payment. Anything is money that meets these conditions. So in the case of the US dollar, it's used because people accept it in the exchange relationships that exist. It stores its value more or less over time. It's the thing that's used to measure what the prices are when we try to buy things. And when we engage in loans, this is the right where we save money. This is the thing that we denote it in, dollars. The Canadian dollar fails to serve these purposes in the United States, right? Because no one's measuring things in Canadian dollars or Japanese yens or euros. But once you go to Canada, well, actually, most of Canada both takes the dollar and the US dollar and the Canadian dollar. So this money is an asset as identified here. Financial assets are also assets. And as I identified here, primarily here we're talking about equity markets and bond markets. And we could also think of it too as bank accounts as another form of these financial assets. Now, what a financial market does, what the purpose that it serves is that it brings borrowers and savers together. And obviously, by being that matchmaker, you collect a commission on bringing those two people together. Um, so it can either occur in the primary market, where you bring the people together for the very first time, or in the secondary market when you resell those bonds or those offerings that you originally had. Now, the prices are fluctuating all of the time. The price in these markets is the interest rate. The prices adjust based on the current economic conditions, even though it has a fixed rate when it's offered. In the secondary market, that would then adjust based on economic conditions. Also, you have present here some measure of risk, and you can buy insurance products to cover that risk. But in these financial markets and in these money markets, you do need a great deal of regulation. And that regulation does help then manage the players, the actors in these financial markets to ensure that people use the markets. Because if you don't have trust in the financial system, you're not going to have a strong system. So as I identified already, the central bank is in the United States is the Federal Reserve. The Federal Reserve controls the money supply. Um, there are other banks around the world, so that's what this slide kind of identifies, and we actually will look at some of those others, namely the Bank of England, probably not the Bank of Canada, but we'll also look at the ECB, the European Central Bank. And then in this last slide for this pretty short chapter, I mean, in the textbook, it is only about 6 pages here. The banks do face a great deal of risk. So banks aren't just making money for doing nothing and looking fancy. They do face a lot of risk. They do have losses. And because the margins can sometimes be very thin in the banking system, and because banks are usually stocks that have earnings that are reported, they do. Some people do take on a great deal of risk. Unfortunately, when bankers take risks and those risks become too large, they can imperil, they can harm the entire economy. And the purpose of regulation is to control that risk that's being taken on. So the mortgage market is a perfect example of lots of mortgages were issued in 2007, 2008, 2006, 2005 because bankers were trying to maximize their profit, yet it resulted in mortgages being made to people who had no business borrowing money for a house. And then that result of that was that um, those those loans failed, and as those loans failed, then the basically the markets, the risk that was taken on became so large that it harmed the entire economy. Okay, so this is a very short chapter. You basically had a very easy first week here with this chapter. So Next, we'll get into um, next we'll get into chapter 2, where we'll start to look at money much more closely.